I don't know if you noticed this, but over the last decade, the number of stocks trading on the NASDAQ has simply erupted. Take a look at that. Obviously, many of these companies are just mostly hype and hope. They're not making money. And of course, it's not just the NASDAQ. The S&P 500 is also seeing intangible assets swell. And now more than 60% of companies have negative net earnings. So a lot of these stocks will make shareholders rich. There's no doubt about that. But the risk-reward ratio is really tough. So how do you find the winners in that scenario? Joining me now, Market Gauge Managing Director Michelle Snyder, along with Defiance ETF CEO and CIO Sylvia Jablonski. Ladies, you're, by the way, two of the very best when it comes to this kind of stuff, so I'm glad you're here. I'll start with you, Michelle. How do you determine, okay, I want to buy a stock even though it's not a profitable company?
Well, basically, I look at three different criteria. So I will always check the macro environment. And obviously, if the market is trending down, as we're looking at right now, and the reasons why, which would be higher inflation and higher interest rates, then that would certainly keep me out of certain companies that might be impacted by that. But then I'll look at a megatrend. So if a company is in a particular megatrend, whether it be social, geopolitical, or economic, that's intriguing and trending, regardless of the macro, I would watch that company. But then thirdly, and most importantly, I'll use basic technical analysis, where if it clears a certain area, whether it's a major moving average or it has a great reversal bottom or it clears a period of consolidation, I will go in, but always priced in with risk.
Sylvia, I know that you're longer term. You're looking like at least 5 years out. But do you also use the old quote, path to profitability? We cannot hear Sylvia right now. We're going to see if we can get that fixed. And Michelle, go back to you. You know, I had a little bit of fun. In our morning meeting, we were talking about those electric scooters because I don't know if they have them in your town. First time I ever saw them was in San Antonio. They were all over the place. I mean, I used to get upset when people would smoke a cigarette and throw it down, like that's a litter bug. Now they're throwing scooters down. In St. Louis, it's not a problem anymore. They actually got rid of them. They said that people actually use them to commit crimes. And the reason I'm bringing this up, one of the hot SPACs last year was that Bird Scooter Company. Well, I got some good news if you're holding the stock. It's up about 9% today. The bad news, it's down 93%. There's a lot of exciting things. Like people were taught, buy what you know. You walk out your house, you love the scooters, you think it's big, you buy it, you're down 93%. How do you avoid that?
Well, again, I mean, basically, we have seen that anything electric had been impacted by so many things, not to mention, of course, the very most of it, which is supply chain. And the whole EV space has gone down as oil and energy has gone up, even though that might reverse. So you just have to use, again, some simple logic. Just because something is hot doesn't necessarily mean it's ready. I mean, Apple was hot for years before the stock actually started taking off after 2007. So timing is so key. And yeah, sitting through a 93% loss is extremely painful. By the way, scooters in general, I don't think they're going to be the next big hot thing.
No, but it was touted. It was touted for a while. I remember reading article after article. Sylvia, I hope you heard the conversation. Sorry we couldn't hear you, but maybe your thoughts on just the process of doing this, and then your overall thoughts on this market.
Yeah, overall, I think that inflation has put a little bit of a thorn in our sides when it comes to some of these high growth opportunities that we're talking about, some of the newer SPACs. And I think in terms of who survives, it's the companies that have strong balance sheet, that are quality companies, that, are part of large secular trends of the future. And some of those things are 5 years out. And some of those things might be things like quantum computing. They might be things like hydrogen, electric vehicle space, artificial intelligence, augmented reality. But some of these things are also here today. And some of the technologies behind quantum computing exist for big data, for machine learning and things like that. 5G exists for electric vehicles. And I think the big companies out there like Amazon, the Googles, Microsofts, and Apples that have been crushed, those are companies that are, growth and tech, right, and sort of being poo-pooed right now. I mean, those are epic opportunities. They're not going away. They have so much cash. They're innovating. And they're part of future growth trends. And that's huge for me when I'm looking at stocks.
I would underline that word you just used, epic. I agree with you 1,000%. If you're a long-term investor, I think it would be nuts to sell it here, particularly at a loss. Michelle, Sylvia, we'll get that audio fixed next time. Thank you, ladies, both very much appreciate it.
Thank you so much.
All righty.